I really hope you're doing well. So right now we're going to take a look at our next question or our final question for the series, which are going to be non-current. Wow, did I really screw this up? This is non-current liabilities. Wow. Good job, Tchaikovsky. Wow. Accounting professor is losing it. Oh my goodness. As the eyesight's going, everything's going. Okay. So coming over here, what we're going to be doing today is we're going to be looking at what happens basically when I give you the bond proceeds. When I give you the bond proceeds, what exactly happens, like prepare the journal entry to record the bond issuance, interest payments, and everything else. So let's go ahead and get to it. Okay, so we've got over here, we've got Gray issued 5 million of bonds and received proceeds of 5.5 million. The bonds have a term of 10 years and a stated interest rate of 8% and pay interest semi-annually. So first things to do is to record the bond issuance. This requires no use of the present value table, so this is going to be pretty easy to do. So 1132, we are receiving cash of 5.5 million, which is what we refer to as the proceeds. Okay, we always record bonds payable at the face value, which over here is 5 million, right? So we're always going to record that bond payable at the face value. My difference here is going to be a premium on bond payable. Why is it at a premium? Because my cash proceeds are greater than the face value of the bond, and this is going to be to record bond issuance. Now, if we looked at a balance sheet on 1132, okay, so right over here in my non-current liabilities, I would be showing a bond payable. I always show bond payable at the face value. Then I would have over here, I would then show a premium on the bond payable. This would be here for 500,000. And then over here, we're going to have bond payable carrying value or CV. So coming over here, when we're looking at our balance sheet presentation, this is what this is going to kind of come through and look like. So we're going to have bond payable carrying value and have this be 5.5 million. Now, when it comes to our goal, is that this bond is basically going to have a term of 10 years. And so at the very end of the bond's term, or 12/31/41, we want to have a bond payable here of 5 million, but we want this premium to have been amortized down to zero. So in order to do that, we're going to have to take this premium that is essentially going to be right over here, premium on bond payable, which is right now a credit balance of 500,000 as of 1/1/32. We're going to have to amortize this premium. So by debiting it, so by the end of the period, it goes down to zero. So again, we would be doing the same thing with a discount. We would just be going the other way. Now, over here, the first thing it's being asked us to do is to record the journal entry to record the payment of interest for the 6 months ended 6/30/35. Okay, so let's go ahead and do this. When I'm paying interest, I have a couple things going on. I know I'm going to have to pay interest expense or the cost of borrowing the money. I know I'm going to have to pay cash. And let's figure out the cash first. The cash amount that I'm going to be paying out is basically going to be my face value of my bond, which in our case over here is $5 million. I'm going to multiply that by an interest rate. My interest rate here is going to be at 8%. Okay. So the annual interest is going to be 400,000. However, This problem tells me that I'm paying interest semi-annually, or I'm only paying it basically every twice per year. So to make this semi-annual, I'm going to multiply this by 6/12. So the interest payment is basically going to be 400,000 times 6/12 or 200,000. So every 6 months, I'm paying 200 grand. Now, so this is going to be to record interest expense. Now, when I'm going through and doing this, I have initially recorded a premium, but what my goal is by the end of the bond's term, when I pay back the loan or when I pay back the bond, I want that to be at zero. So that means I'm going to have to debit premium on bond payable. So right over here, I'm going to have to debit premium on bond payable. Now, when it comes to debiting for the amount, the way I'm going to do this is I'm going to say, okay, my premium on bond payable is 500,000. Now I have to say, how many times am I paying interest? Well, this is a 10-year bond and I'm paying interest semi-annually. So over here, so this is a basically number of interest payments. This is going to be a 10-year bond, 2 times interest payments each year. So over here, this is going to be 20 interest payments. So what I'm going to need to do is I'm going to basically need to take 500,000 divided by 20, and I get 25,000. So every single time, and this is what we call straight line amortization. Straight line amortization. This is not the effective interest method. That's very different, but we're going to be doing it for our purposes, unless it's extra credit. It's going to be straight line. So over here, my amount of my interest expense is going to be 175,000. Now, if I made this on June 30th, 2040, it would be the same entry. It never changes. So figure out the cash that is being paid out first, then figure out your premium on bonds payable. Remember, I want this to go down to zero. If I take 25 times 20 payments, which is 10 years at twice per year, I'm going to get 500,000. The difference, or the 200 minus 25, is going to be my interest expense. Let's now go over here and say, prepare the balance sheet presentation for bonds payable as of 6/30/38. So now I come over here and I want to know, what is my balance sheet presentation going to look like as of 6/30/38? Well, I already know that I have over here, my face value is always going to be 500,000. But what I need to do is to figure out, well, how many times did I go through and amortize interest? Now, you can do this a few different ways. I'm going to go here and do it basically 12, 31, 32. Okay. So you don't have to do this, right? But every single time I'm paying interest, I'm coming over here and I'm basically going to be doing this by 25,000. Now, if I come over here, what I'm going to end up doing is I have over here a total of 325,000 in debits, 500,000 in credits. I subtract the smaller from the larger side. And then basically my ending balance is going to be 175,000. So coming over here, my premium on bond payable has been amortized down to 175. Whatever way you choose to go through and do it, just make sure you're counting out these different periods. Where I've seen students make mistakes on my exams is they don't basically count it out properly. So make sure you're going through and doing that. Okay, let's go to our next example. Okay, so let's take a look over here. So for this example over here, so we've got over here, Aussie issued $12 million of bonds and received proceeds of 11 million. The bonds have a term of 8 years and a stated interest rate of 10% and pay interest annually. So on 1/1/33, I'm receiving cash of 11 million. I always record the bond payable at 12 million. So when I see the term proceeds, that means how much cash I received. Because the bond payable face amount was higher than the cash we received, that must meant that the bond is issued at a discount on bonds payable for a total of $1 million. So this is going to be to record bond issuance. Okay. So now in terms of my balance sheet, right? So my balance sheet as of 1/1/33, what does this look like? Well, we have our bond payable, but this discount on bonds payable is kind of like a contra-liability account. And this is going to be bonds payable net of the discount. So on our balance sheet, under non-current liabilities, when we initially issue the bond, it's going to look like this, right? So this is what this looks like. Now, similar to what we were going through and doing just a moment ago, this discount on bonds payable, it's a contra liability account. So therefore, it is going to have a debit balance, right? The discount on bonds payable. Now, our goal is basically similar to what we were doing on the last problem, is when the bond matures in 8 years, which is going to be 33, 34, 35, 36, 37. On 12/31/40, we want this discount to be at 0. So we're going to have to amortize this discount. So when we come over here to do the interest payment, and 12/31/34 doesn't matter because this is straight line amortization. Need to know a few things. I know I'm going to record interest expense, right? I know I'm also going to be crediting cash, and I'm also going to have to credit discount on bonds payable. Why am I crediting discount on bonds payable? I need this to go to 0 by the end of the bond's term. So over here, what I'm going to go ahead and do is say, okay, to record interest expense. First thing I need to figure out is, what is my face value? Well, my face value is 12 million. What is my interest rate? Well, my interest rate, or the amount of interest I have to pay every year, is 10%, and that is an annual rate of interest. So my interest payment is going to be 1.2 million cash. First part, how much cash am I paying for interest? Now, in terms of the interest expense, though, I need to take the discount on the bond payable. My discount on the bond payable is going to be $1 million. And I need to divide this by the number of times interest is paid. Right over here, the number of times interest is being paid is 8 years, and it's being paid annually. So right over here, this is going to be 8 years. So this is going to be an amortization of 125,000 per year. So I'm going to credit the discount on bonds payable for 125. So that means my interest expense is going to be 1,325,000, or 1.2 million plus 125,000. This is how I always go through and do my interest computations. Okay. Now, last thing I'm being asked for is the balance sheet presentation for my bonds payable. And it's being asked me for as of 12/31/36. Now I know that my face value always has to be the 12 million, or at least for this particular question. So what I need to figure out though is what is the amount of my discount? Well, on 12/31/33, I amortized the discount by 125. Did it again for 125 the following year. Another 125. And so I've amortized this. How convenient. A lot easier than the last one over here. 4 times. So it's a 4-year bond. Excuse me, it's an 8-year bond. And we're halfway through. Okay, so coming right over here. Basically, my discount was 1 million. I subtract the smaller from the larger side, leave the remainder on the larger side. Remember, this has a debit balance as a liability. It's a contra-liability account. So we're going to go ahead here and show this as a negative 500,000. So basically my bond payable net is going to be 11.5 million. I'm not sure if I would call it a contra liability, but it reduces the bond payable to its carrying value. We're adjusting interest expense over time for that discount. So that is how we go through and do these types of questions. Remember with all of these is that there is an assumption we're going to be amortizing the discount or the premium straight line, not using the effective rate of interest. So I look forward to seeing you on the next video. Have a great rest of your day. See you soon.